Welcome once again to the Harmonic Trader Monthly Program. My name is Jonas Hunter, and I'm here with Scott Carney, creator of the Harmonic Trading Approach. We examine a variety of markets from the perspective of harmonic trading and review Scott's topics that he's addressed in this month's report. Now, you can access a free trial to Scott's monthly report at his website, harmonictrader.com. All right, Scott, first of all, how's things going down there in Miami?
Jonas, how you doing?
Doing fine. Things are...
Again.
Yeah, absolutely. So, look, Christmas is approaching. People may have money to invest, they may not. But for those of us that have a little bit of money to invest, I'm seeing a lot of things all over the place. Now, first of all, what I'm reading is the fact that we have tech stocks and these so-called unicorn stocks, these Silicon Valley hot $1 billion or more companies. And there are a lot of investors saying that perhaps maybe this is just a wave that you need to ride, or maybe you don't need to ride. So between tech stocks, between Silicon Valley, and then news of all these crude oil ships out in the Pacific that are just basically circumnavigating and not being able to unload their oil because the Arab nations are pumping out so much oil that there are no buyers. How does all this play into the economy, and how does it affect everything?
Well, Jonas, a lot going on, a lot in the last couple of weeks geopolitically. I think that has people kind of looking every which way for direction. And, there are a lot of fundamental economic stories that are unfolding now into the end of the year that will really set up everything for next year. I think we've been talking about this since August, where what we're looking at is this whole scenario of what will happen in 2016. So we've got this aberrational unicorn situation, that is privately held companies that have a valuation in their private stock in excess of $1 billion. Now, we've seen this where a lot of the successful unicorns like Facebook and others have gone on to tremendous success, but the reality is that the majority of these startups never reach their full valuation. So what that to me says is that it's a sign of overexuberance, a sign of overvaluation. The market has moved too far in one direction too fast. That is overvaluing every new startup app program, software, networking, security program that, is, again, reflects what we're seeing in the broader market. You and I talked about it last month. We talked about where a lot of these stocks, like the top 10 NASDAQ stocks, the FANG stocks, Facebook, Amazon, or Apple, depending on who you're talking to, Netflix, Google's now called Alphabet. But the real story here is that the gains that we're seeing across the board that are reflected in the NASDAQ and the S&P 500 are due to primarily 10 companies. And that sets up a problem for that if the broader market continues to weaken, that will affect these top tier stocks. There's no way it can't. And the other aspect of it is that this is usually another sign that we are in the late stages of this bull market. So that just to me acts as a warning signal that you're going to plow money into NASDAQ stocks that are overvalued, much in the same way they were in 2000. We talked about that last month there's a lot of similarities here of the condition of the market as it was in 2000 versus now in 2015. Now, it's different because in 2008, that was severe for the Dow Jones Industrial Average and the S&P 500. NASDAQ took a hit, but the NASDAQ really took its brunt from 2000 to 2002 where the NASDAQ composite went from 5,000, literally losing 80+% of its value to bottom eventually at around 800. That 1,000 mark was a clear psychological level. So then fast forward to today, 6 years later. I mean, incredibly, you got to think about this. 5 years ago, 6 years ago, end of 2008, early 2009, the NASDAQ composite was trading at 1,000. And now we're back at 5,000. Whether or not that was overdone on the downside, I think it was. The pure fact that we have run from 1,000 to 5,000 in 6 years is a hell of a move. And there's only, so far the market can run in any period of time. The market has to go up to go down, has to go down to go up. What we have seen for 3 years is straight up. So now we're hitting the all-time highs in the NASDAQ. We got stories like these unicorns, that extreme overvaluation in the private market, combined with the things that we've been talking about, the bearish patterns in the NASDAQ tech stocks, the broadening, weakening of the market in general. For example, Russell 2000, that's a broader index of smaller companies. It encompasses more of the economy, and even the NASDAQ, the Russell 3000, which is about 98% of all stocks. Of that group, 50% of that group is 20% or more off the highs, in many cases 30 to 50. And this sets up a situation where one of two things can happen. We can either see an improvement in the economy where those stocks that are down represent a phenomenal buying opportunity, and the leaders will just continue to lead. Or that broadening market, that weakening in the broader stocks will continue to weaken, which will then undercut this progress that has been so top heavy in those NASDAQ top 10 stocks. I'm of the latter opinion. I really think what we have here is we have a situation where a unicorn story like that is just one more anecdotal story, evidence that this market needs to be taken with extreme caution.
Well, one of the major criticisms of the unicorn stocks is that they can raise a large amount of cash, but they don't have a sustainable business model.
Yeah, in a lot of these instances, these companies have zero earnings, little sales, and we've seen that before. We saw this is actually another .com. This could be a second generation .com bust. I think what has happened though, following the Facebook example, is that a lot of these companies just see dollar signs, and then their investors and the private investors who think they're getting in on something early because they. A lot of these guys were able to get into the Facebooks super early, that before Facebook reached $1 billion valuation, there were a lot of early investors who were criticized because they thought Facebook, at $1 billion is crazy, only to see Facebook reach a $300 billion valuation. So everyone's pretty, their perspective is distorted. And they're thinking that even though maybe some application, some software program might be the next big thing, there's always going to eventually be an adjustment to what the market dictates as fair value. Right now, the market is flooded with cash, and it's rushing to any kind of startup in hopes that they'll receive $1 billion valuation, because it almost feeds on itself, where if they reach that $1 billion valuation, they're likely to get even more money. But the reality is we've got other stocks like the Groupons of the world, which was a favorite stock of many people that lost 80-90% of its value. There's many of these type of startups. We've even seen stocks like GoPro, perfect example, concept stock, hottest stock 2 years ago. Came out in the IPO, rallied to 100, fell down to 30, rallied back to 65, and then within 30 days moved from 65, lost half its value. Now it's trading around under 20 or at 20, and that stock's in serious trouble. And there's a number of these that tell the bigger story. The whole market is being masked by the likes of Amazon, Netflix, Google, Microsoft, Apple to a lesser extent. So these are warning signs. These are the same warning signs that we saw in 2000. Now, I want to follow that up with your second point about all this oil floating around the world. And yeah, those stories are true. And I think if you look at the charts, we have talked about oil previously, where I said, back in August, I think I said 38 was the clear make or break. There's a number of weekly patterns and long-term measurements, and I mean, I'm going back like 10, 20 years, that all define that $38 level as the absolute make or break. Recently, we've seen the market rally off of that 38 back to 50. But we did a show, I think it was about 2 months ago, where I said the new norm is going to be under 50. Before, it was plus or minus 100. 5 years ago, is oil going to be plus or minus 100? Then a couple months ago, we were saying, all right, the proposition is plus or minus 50. And I said the new norm is under 50. Well, now we're on the verge of breaking those lows. The new norm is not going to be under 40. It's going to be 20-something a barrel. And that is simply because there is a huge glut. We've got, as we said before, we've got Iran, we've got Iraq. Despite all this other stuff that's going on in the Middle East, all these countries are pumping like mad, and they have no choice but to continue pumping to get themselves out of the financial dire straits that they are in. Great band, by the way. But, I don't like what I see. I don't like, I see this further glut, that feeds deflationary fears. That's not a sign of economic activity. That is a sign that the world needs less oil, that the economic activity is still lagging in a major way. And if we look across the major international markets, we only find those two markets, that NASDAQ 100 and S&P 500, as the only two markets really that are holding their heads close to their all-time highs. We talked about this before. Brazil, bear market, almost a depression, down 75-80%. Russia, ditto. India, not as bad, down 20-30%. And China, the focus from since the middle of the year, still doing nothing. China did not recover from that collapse earlier a few months ago. It's kind of holding its head, but still well off the high, this year's high, and seriously lagging in relation to the last 10 or 15 years. I mean, we have, in relation to the 2008 low, China is really close to breaking down and threatening to retest those 2008 lows, much like Russia did, much like Brazil did. And this, against the backdrop of these other markets, does not suggest that this is a broadening recovery. If anything, it's a weakening recovery. And if we see oil go under 38, you're going to see a lot more of that. You're going to, it was funny that happened in the 90s. And, a lot of those oil tanker stocks were, they went up. And it might be one area to look at is those tanker stocks, because these countries are going to still pump as much oil as possible, but they're going to look to store it at anywhere they can in the hopes that in 6 months or a year down the line, they're going to sell it at higher prices than they have now. But that is not.
Yeah, let me throw some numbers at you right now. They say a record stockpile of 3 billion barrels is sitting out there right now. 487 million barrels of crude oil is sitting in the U.S. inventories alone. And oil, like you said, down 60% of its value over this time last year, and we're down to $2 a gallon for an average price across the country. So at times, do you see it dropping more as stockpiles continue to go up?
Definitely. I think this is a situation where this is feeding on itself, and that if we don't, if this was going to be a significant low, if this breakdown of the past 2 years, year and a half, and this test of the $38, $40 level, if that was going to be a serious long-term low point, this price in oil would be a lot higher. It would be rallying. It would be exhibiting some type of recovery character. And no, the character of this trend is still down, and it's threatening to violate some significant measurements at that 38 level, $40 level. I think it's just a matter of time before it does. When it does, I think that's when you're going to see the second phase of all of these issues come up. If it's continued problems in China, if it's weakening in the United States, if it's a stronger dollar, I think that all begins on that break at 38, and I think oil probably holds the key for most of these markets, including the United States.
Well, a stunning fact, Scott, I did the inflation calculator a little while ago, and I went back to 1970 when gas was 36 cents a gallon. Adjusted for inflation, today gas is actually cheaper than it was in 1970.
That's pretty amazing. That's amazing, and there was this huge bear market, 73, 74, that a lot of people, and we, again, another point that we talked about where you were asking me a few months back if lower prices at the pump would help the economy. I think there's an example right there where actually when prices got low, we get into these deflationary climates. That's not good for economic growth. That's actually a sign of weakness. And a lot of times that's directly manifested in the oil market. And I think that's probably the situation that we have. And for the better part of the year, I've been talking about this adjustment phase. The adjustment phase that the conditions that have initiated and stimulated the growth in the markets over the last 5 years, the easy Fed policy, the easy Fed money, the low rates, has stopped. And now we're going through this adjustment phase where a new reality, a new policy, new rate structure, if we're going back to, as they say, normalized rates, even though it's not normal rates, but at least starting to get back to some type of interest rate structure, no matter what, the markets are going to have to digest that. And in that digestion phase is where prices are probably going to be affected, that they have to be revalued. And that's going to happen. That's all next year. I mean, that next year starts in about 4 or 5 weeks, where I expect this market to roll over. If it's going to roll over, it's going to roll over starting January 2nd. They'll probably be able to prop it up till the end of the year, but I don't expect a big Santa Claus rally. I think the markets, the S&P and the NASDAQ, are right about where they probably will be in a month. And I really am looking for this thing to roll over right off the bat in early January.
Awesome. Well, I also did an inflation adjustment for Rolling Stones tickets, and those are really overpriced still. So no, compared to 1970. Well, Scott, very good, insightful information. We'll definitely have another program, maybe 2, before 2016 kicks in, and we look forward to hearing more information through your Harmonic Trader website and talking to you more about what we see or can forecast in 2016. This has been the Harmonic Trading Podcast. My name is Jonas Hunter for Scott Carney. If you need more information about their harmonic trading perspective, please visit the website harmonictrader.com. Until next time, folks, have a great one.